The most common claims made against investment advisors are in negligence, breach of fiduciary duty, and breach of contract, with fraud claims less common. Matthew Taylor, litigation lawyer, it's good to have you on the Personal CFO podcast.
Hi, it's great to be here.
Can you give the listeners a brief introduction of yourself and what do you do?
So, I'm a litigation lawyer. Specialize or a big component of my practice is investment loss claims. Those come in two kind of main formats. One would be claims on behalf of individuals or groups of people against investment advisors, what you were referring to a moment ago. That's a very common sort of claim where they feel that they've been given bad advice and as a result, they've lost money. And then in the class action bucket, there are also investment loss claims. That's typically shareholders of a publicly listed company suing the company for failing to disclose something about its business practices or its financial outlook, for example. There are also sometimes claims against asset managers. So if people hold units in a mutual fund, claims against the fund manager if they say the funds were not handled appropriately, they weren't invested appropriately, disputes of that kind of nature.
Okay, I'm excited to dive into a few of the cases in today's episode. But before we go deeper, can you tell the listeners, like right now, listening to this conversation, why should they stop and spend the next 30 to 45 minutes of their time listening to this conversation on negligence, scams, and fraud?
Well, I would say that these problems are something that are accelerating now, and nobody wants to end up in a lawsuit. That's true of the people being sued, obviously, but it's also true of people who are suing. Something bad has happened to them. They need to go to all this trouble. They need to pay somebody to do it. Nobody's happy about it. But it's kind of like insurance. You do it, and you might want this information for the same reason you want insurance, which is hoping that nothing happens to you, but being more prepared to be able to address things hopefully earlier. Sometimes that can prevent problems. Or if nothing else, at least be able to engage a lawyer sooner so that you can make sure that your rights are as protected as they possibly can when something goes wrong.
So, who do you think this conversation would be useful for today?
I think it would be useful for anybody who relies on professionals to manage their finances or some aspect of their financial or business life. These disputes can really affect anybody who engages somebody in an advisory relationship, right? That can be relevant to people who engage lawyers. Lawyers get sued sometimes. It can come up in a huge number of different ways. And frequently, people are simultaneously dealing with the emotional fallout of finding themselves in the dispute while also trying to figure out how to navigate it and gather the information they need. So hopefully, if you have some of that information beforehand, it's a little bit less overwhelming and you can make better decisions along the way.
Yeah, I think that's a great way to phrase it. And hopefully, through this conversation, they'll be able to gain the knowledge if they ever end up in a situation that maybe been mistreated as clients, or there was negligence there. And like you just said, hopefully, it might be like a term insurance where it never gets to actually be, utilized and it just expires worthless. But at least they'll have that knowledge in order to discern if there was some wrongdoing there in the advice that they received.
Yeah, and I would also add, I suppose, even if somebody doesn't need it, unfortunately, there's a lot of instances where this kind of thing comes up with older people too, who frequently have a lot of assets, but they may have declining capacity or they may be more vulnerable. So it can also be helpful in terms of just loved ones who may have some of these issues arise. Hopefully not, but always better to have the knowledge and not need it than the other way around.
Yeah, that's a great way, of course. And if they do find this conversation useful, they can always send it to someone who may be in a cohort that is more at risk, like you said. Definitely, maybe they will find that conversation useful. Okay, let's dive into it. I want to start with I want you to give a bit more explanation as far as how does the system works. Even for myself, when we first met, I just was curious to better understand how do you get compensated if someone feel that they've had maybe a bad experience or there was some negligence or they've been, I guess there was some wrongdoing there in terms of the services that they got or the advice that they got. What's the first step that they're taking, and how do you guys actually work with these people?
So, in terms of engaging a lawyer, if you want to hire me, for example, there's two kind of major ways that these agreements will work. So, there's an hourly billing model. And that's pretty simple to understand. Most lawyers have an hourly rate. You hire them however long they work for you, they charge you based on that rate. You work 100 hours for somebody, you have an hourly rate of $500. 100 times 500 is what the bill is. It'll be billed monthly, and it goes on until one or both sides decides that it shouldn't anymore, or hopefully that once the matter has a positive ending. So that's sort of the traditional model. As you may expect, given the nature of some of this work, frequently people have lost a lot of money. They may be quite illiquid when they require this kind of service. So there is another kind of arrangement, which is what's called a contingency retainer. So that is pretty simple to understand as well. An agreement where the lawyer only gets paid if there's like a successful outcome, whether that's a settlement or a judgment, and they get paid on a percent basis of whatever that is, typically somewhere around 30%. So just to make the math simple, there's a settlement for $1 million, the lawyer would get paid 30% plus the sales tax on that settlement fund. So there are pros and cons to both models. Obviously, contingency arrangement, people like that they're not paying if there's not a successful outcome. It can be better from a cash flow perspective. Of course, in order to take on that risk, there's frequently greater compensation for the lawyer in the event that there is a successful outcome. So that's kind of the trade off and what people need to consider when they are trying to find an arrangement that works for them.
How does that shape how you decide like which case to take on and which one to pass on?
So on the hourly billing model, I would say generally you'll be able to find somebody who is willing to represent you. And lawyers have a duty of candor. They need to tell their clients their honest assessment of things. If they think the claim is weak, if they think that they're not going to get much money at the end of the day, they need to advise their clients of that. But for a variety of reasons, people might want to proceed anyway. And if it's a weak or low value claim and you want to do that, I am confident you'll find somebody that will do it on an hourly basis. Obviously, on a contingency basis, it's a little bit different. So there's two main criteria there. One is a claim needs to be of a certain size before it can be economical to do it on a contingency basis. Nobody would make any money on a $10,000 dispute compared to how much time they would need to put into it. That's just a reality. It is still a business arrangement. And then the other is the lawyer needs to be quite confident in terms of the merits of the claim. So they need to be pretty confident that the client will ultimately succeed or they've got a strong chance of success because there's absolutely no guarantees in litigation. You can have degrees of confidence, but at the end of the day, anybody has the possibility of having an adverse ruling and just having their case tossed out. Lots of things can happen over the span of a lawsuit. So, from the lawyer's perspective, there's a lot more workup for a contingency arrangement. You need to really dig into the facts pretty early. There might be some sort of hybrid arrangement where there's a small investigation fee up front and then there's a decision that's offered to the client. I'm willing to offer you a contingency retainer or I'm not. If you want to proceed on an hourly basis, we can talk about that. So there's more process on the front end and the lawyer needs to be more selective. And I mentioned the need for a higher claim value. There is a caveat or an asterisk to that, which is that if a large number of people are similarly affected, let's say a large part of an advisor's book of business, even if the claims are smaller, if you group them together and they're worth more, you may still be able to find somebody who would do it on contingency because there are economies of scale from putting people together like that.
Which makes sense. Which model have you or which case in terms of like model and cases that you've worked on have you preferred in terms of intellectually challenges and in terms of I guess percentage of winning for your clients? Is this model
So
one
the
that is it prefer yeah is it one that is more preferable than the other in terms of having a positive outcome for the client you're representing?
I think it's really a pretty individualized decision on the client end. I would say that most of my work has been on a contingency basis. I do take some hourly mandates. In particular, I've done some defense work in commercial litigation. When you're defending, you can't do a contingency just because you don't expect a payment of money at the end. So I would say the majority of my work has been contingency, and that's the way that I see my practice continuing. And when you're billing hourly, you need to have some pretty difficult conversations at times where people can be pretty deep into things and they need to make a decision about how much more they want to put into it or what kind of financial effect it's having on them. Whereas contingency, some of that component is a little bit simpler. Like the immediate financial pressure from the litigation itself is quite a bit less because you're not getting monthly bills sent to the client.
So I can help. Yeah, that's interesting. I want to talk about at least four cases that I would like to pick your brain on that we previously touched that I think would be really interesting for the listeners to go over. And through these cases, I want you to kind of highlight what were the premises or what was the supporting kind of arguments around the case itself, just giving some detail what went wrong and what could have been avoidable, not only from the advisor side but maybe or preventable, so to speak, maybe on even on the client side, to help clients kind of foresee bad outcomes. Essentially, that'd be my hope while we go through these cases. So can you talk about the first case where you mentioned there was a gap not only in knowledge but also in language between an advisor and a list of clients, and then what happened there, and how what was the wrongdoing there by the advisor to the clients?
Yeah, so I would say a fairly common pattern is what you said, where there's not only a gap in terms of knowledge, because there's essentially always a knowledge gap. It might be bigger or smaller, but you're generally going to a professional because you want their expertise. So you have kind of an inherent monitoring problem, and that it's very difficult for even a sophisticated client to understand if the service they're getting is exactly what they should be getting. Like it's kind of a built in feature almost. But that can be exacerbated in a lot of different circumstances. And one of them is linguistic. Of course, Canada has two official languages, English and French. If you're dealing with a financial institution, they'll always have their documents and everything related to your accounts available on one of them. They'll frequently be able to make it available to you in both languages. So if you're a native speaker of English or French, it's pretty easy for you, if you're so inclined, to look at the account documents, see what's going on, have a conversation with your advisor about them, because that's another way that we can narrow some of this knowledge gap. And that's another way that can hopefully prevent things from going wrong. But if you've got a new Canadian, let's say, or a group of new Canadians, a common sort of fact pattern that you'll see is somebody is coming to Canada with money. They want to retire here. They want to live a life here. They've made their money elsewhere. They don't foresee a need to work. They're perfectly okay getting by most of their day to day life within their own community, where it's not a major impediment for them that they have little facility with English or French. These people will naturally gravitate to wanting a financial advisor because they've got a large sum of money that they want to manage for a long term purpose and they want to make the most of it. They will also naturally gravitate to an advisor that has a shared cultural background with them or a shared linguistic background. And that will be an added sort of element of trust because to a degree, they're out of their element just being in Canadian society and having this linguistic barrier. So if you want to entrust somebody with your retirement or basically all the money that you have, very natural thought process to go to somebody that can communicate with you clearly. And then the disconnect can come in terms of the documentation with the firm that's involved, because these people are always going to be affiliated with a firm. And just because there's an individual advisor that can speak Spanish, Mandarin, whatever language, that doesn't mean that the firm is actually set up to have all of its documentation available in those languages. So the client is immediately much more reliant on the advisor in terms of understanding what's going on, understanding the consequences of the contract that they're executing. Sure, they could go off to a lawyer and have them translated, but they're going to have to, one, get them translated. Account documents are frequently lengthy, they're technical. You can't necessarily just go to any translator to do it. You would need somebody with a finance background likely. And then you would then have to engage a lawyer to look at it and walk you through it or walk through your advisor with it. So there's a lot of extra steps, and people are probably feeling like, I trust this person. I can understand what they're saying. It makes sense to me. They get me. I don't feel like I need to do that. If they're telling me I need to sign the paperwork, I'm willing to take them at their word. They've been nothing but good to me so far because they are, again, relationships of trust. So, the majority of professionals generally, I think, are trying to do right by their client. They're trying to do a good job. They want to rest on the quality of their work product. There's always some subset that is either not going to bother to do their job right or is actually going to take advantage of their clients, unfortunately. So if somebody is so inclined and they can speak another language and they build this kind of book of business, it's much easier for them to in some way get away for a while or take advantage of their clients because of all of these structural features. And frequently, this person or their staff might be the only individuals of the firm that the client can even properly communicate with, right? So for them to monitor the relationship is much more difficult on top of all the normal barriers, such as differences in knowledge and expertise. So, the case that we were talking about had all of those sort of factual features. There was an advisor that was fluent in a non official language. They built a large book of business and they were focusing their client base on other individuals that spoke the same language. And another common feature of these kinds of cases when they go wrong is that the advisor will have sort of a one size fits all solution in terms of the investment strategy that they suggest for their clients or other aspects of the planning relationship. And that was the case here. And it was a peculiar high risk strategy. What we talked about was an investment strategy that was premised on leverage through shorting of government bonds and then using those proceeds and the client's capital to purchase a large amount of floating rate preferred shares. So both those positions are interest rate sensitive. The idea on why it was appealing to these clients who wanted income that weren't working and they had their nest egg was that the leverage allowed them to crank up the amount of preferred shares. That gives them a higher monthly income and it also allows them to service the short. So it seems like, kind of effectively free money if you don't understand the risk. The wrinkle is that both those positions are interest rate sensitive, and the spread between them narrows if the interest rate environment deteriorates for that position. And that's exactly what happened in a file that I worked on. The interest rate environment changed. A bunch of people got margin called, and prefs are also quite illiquid, floating rate prefs in particular, I understand. So there are a lot of people that want out at the same time. That puts further pressure on the prefs in order to close out some of their short. So everybody found themselves in a very difficult situation. They didn't understand that there was this risk inherent in what was going on, and they trusted this person more or less entirely. They didn't think it was a high risk strategy, and everybody found themselves getting squeezed at the same time. That kind of fact pattern, where somebody's entire book or a significant chunk of it ends up kind of imploding at the same time, is a pretty common feature of these kinds of cases. And that's also part of why it makes a lot of sense to group people together to help them pursue the individual that gave them the bad advice.
Mm. Yeah, so there's a lot to unpack here. The biggest, I would say, common mistake in terms of like what's going on in this specific case is was a mismatch in what the clients needed and how the portfolio was positioned, right? Ultimately, and the retirees are by far the most at risk because what do they want? Income. And the entire industry, investment industry, is built on how do you provide income. Ultimately, that's what it comes. And there's all sorts of products out there, right? And we're gonna go through a few. You alluded to them already. I mean, pref shares that strategy is probably one of them. And then there's a ton others, right, in the private market space, which we're gonna get into the case number 3. But the whole point was there's so many options out there for advisors, and then there's one need by the client, which you need to service that. And then in this specific case, they didn't even understand English or French. And I would assume there was a massive gap in knowledge between understanding what was going on under the hood, which I think is not only present in this specific case, but I would argue in not over 90% of relationship between client and advisor. I don't think people understand at all what's going on with their money unless the advisor has like explained it clearly or maybe is using a strategy that is simpler to understand, which I would tend to believe that that's an approach that we took. But my question to you is, what is the difference between an advisor who's legally required to act in kind of your best interest as a client and one that is just suitable and that just needs to recommend something that is suitable? What is the legal distinctions here? In this specific case, was the advisor doing the best in its capabilities based on what they knew, like maybe taking the short selling apart, which that was more overly aggressive. But the rest of the strat, like he just tried to meet the needs. So what went wrong from a legal perspective here?
So I think you hit the nail on the head, and that was in terms of understanding the client's needs. So there's 3 sort of key components from a legal perspective, at least, to the relationship, which is the advisor's obligation to know their client, KYC, know the product that they're suggesting, KYP, And then suitability is matching the client's needs to the appropriate solutions, the appropriate portfolio of products, or whatever it may be. So if the advisor is a one size fits all strategy, I would be quite surprised if that was actually appropriate for everybody in their book of business, right? Like, even if everybody wants income, like you're saying, people have different risk tolerances, they have different risk capacities, that's a distinction that doesn't get picked up on a lot. Somebody might have very high risk tolerance but very low capacity. And the advisor needs to take all of this into account, the client knowledge, all of that, to fulfill their KYC requirement. And then on the product side, they need to understand everything that they're pitching. And if there's something like a highly interest rate sensitive product, that's something that they need to understand when they're putting the strategy together to actually arrive at suitability. But to loop back to your question, legally, the difference between best interests and suitability, I would say the biggest difference there is in terms of how fees can be acceptable. So you can theoretically, as an advisor, put together multiple suitable portfolios. You might have a different shelf of product that's available to you, and you might be able to come up with many different suitable arrangements for your client while doing your job legally. There's no problem. That advisor that doesn't have the best interest requirement, it would be committing negligence if they selected a suite of solutions that paid them higher fees, even if that might have the same return or perhaps even a slightly worse return for the client. That could still be found to be suitable, and they might do it out of their financial motivation. So that won't always be the case. There could be situations where that's still negligence. It's going to be a lot more of a question mark. But if there's a best interest standard, then they won't be able to do that. They need to be motivated completely by what's in the client's best interests. And they can be paid, obviously, they're providing a service. But to put their own interests ahead of the clients like that, they would still be able to be sued like that. They could run into regulatory trouble in that same sort of fact situation. Legally, how you get to the distinction is the court will look at the entirety of the relationship and it will look at what's actually happening. So whether somebody advertises best interests or they say they're a CFA or they're a part of some other organization that is supported a best interest standard, the court's going to look at what's actually going on. And they're going to look at both sides of the relationship. They're going to look at the client side and the advisor side. And there's five main hallmarks. The first is vulnerability. So that's on the client side. Clients can be more vulnerable because of linguistic gaps like we've been talking about. It might be a knowledge gap. It could be age or a decline in cognitive capacity. It could be education. There are a million different ways that somebody can be more or less vulnerable. If you're more vulnerable, it's more likely that the advisor is going to owe you best interest duties. The degree of trust is something that's going to matter. So if it's a long-term relationship where the client trusts them completely and the advisor has invited that trust because both sides matter, they've accepted that trust, they haven't said, I'm only helping you with X or Y, then again, that's going to be something that will gravitate more towards best interest. Reliance, that's a big one. So if the client is always accepting the advisor's advice, if they 100% of the time over the course of a decade take it, they're relying a lot on the advisor there. Again, that'll move the needle more towards best interest. And at the same time, if the advisor invites greater reliance, they say, I have this special skill, I have this particular knowledge, this expertise that you can't find elsewhere. They're inviting that greater degree of reliance as well. And the most important factor is the degree of discretion. So whether it's a managed portfolio account, whether there's a document in place saying that the advisor can make transaction decisions without explicit client authorization for everyone or not, if there is discretion being exercised in reality, if the advisor is treating a non-discretionary account as discretionary,
Mm.
that is beyond being a breach of regulation, also something that could grant a claim of negligence. That's going to move more towards them owing a best interest duty as well. And the last piece are the professional rules they're subject to in any codes of conduct from, let's say, something like the CFA organization. If they've got a special designation and that's something that they advertise, that's part of how they solicit business, and that organization holds them to a higher standard that might suggest a best interest standard, then that's something that the court will look to as well and say that in all the circumstances, this particular relationship, the advisor owed best interest duties.
Yeah, thanks for the elaborate answer about the five components. No, that was great. I want to go back to the risk tolerance and risk capacity points that you touch on, and as well as like needs, of course, and linking together. Like in the risk tolerance side, I think a lot of even advisors and definitely clients like don't really understand kind of where the risks are coming from in their portfolio, right? On the risk tolerance side. And that's why we, pride ourselves. And I joke that we know everything about our clients, like even the color of their underwear. What that means is that when you do like thorough financial planning, because it's so broad in terms of concepts, right? The cash flow, tax, retirement, investment, estate, and insurance planning, like it's all within. If you actually encompassate everything around the plan, like you'll literally know everything about that person and that family, which makes it, my point is that it's really easy to not only quantify their risk tolerance but also the risk capacity, which is linked, right? So I think that that's an interesting. My point is that this concept of risk tolerance, it can be very easily overlooked because at the bare bone is like a list of questions, really yes or no, and then it kind of spits out like a somewhat of a range, so to speak, with like A, B, C, D, sorry, answers, and then it spits out sort of a range, and that's pretty much it in terms of like having an MFD license like myself. I think the bar is extremely low, so I feel we are levels ahead of what kind of the industry, I guess, is requiring us. And then the other point that you touch on was, yeah, know your client, KYC, but know your product. Know your product. I also think that the standards I feel from our industry is extremely low. One conversation I had with a compliance officer is, Guillaume, I just want you to know one thing at least. Which quartile the mutual fund you or ETF you're recommending is in? And that was a know your. And I was like almost like my point is like imagine if that's what we're requiring on us to if I can put like a suggestions or representations or an offer to a client in terms of how they should invest their money, and that is the benchmark that I need to kind of meet, let alone like in understanding kind of the intricacies of the investment strategy underneath, and which is what that should be the bare bone. Like you need to really understand the intricacies of how the money is managed in order to be able to advise the clients to, and then try to simplify it for the client. But I think, yeah, the fact that you touch on this, I think our industry, yeah, the bar is extremely low, and the hope with this podcast and also the work and what we do is try to elevate it to a level that is much higher. And that also it can be tricky the way the industry even qualifies certain products, which was also my point, is you cannot have a product that is rated like low risk, medium risk, like this, for example, this preferred share example. I'm not sure what those preferred shares were in terms of kind of maybe risk, overall strategy risk rating, but of course the short side was probably definitely classified as high risk. But sometimes I feel even their characterization of the risk rating of the products that we offer is somewhat questionable. For example, 100% equity portfolio might be rated like medium risk, and another equity portfolio is going to be rated high risk. But again, ultimately you have very much like similar equity exposure. Maybe one you're more diversified than the other, but I don't know, it's just interesting how the industry can kind of qualify these investments, which I think this is where your professional and your understanding of the strategies underneath can help really override, I guess, those ratings to better align with the client's needs. That's my um,
Yeah,
yeah.
I think that's all right. And, I obviously see a particular kind of relationship because when things are going well, people don't typically need to come to me. But I would say that a lot of the risk conversations that I've talked to people about have effectively been like, here's a KYC form, pick the number 1 to 10, or pick between A and E, without really asking the hard questions like, well, if you lose your job, how many dependents do you have, what are your liquidity needs, all of those kinds of things that can influence the risk discussion. Because I think a lot of people also kind of naturally overestimate their own risk tolerance. But if you really interrogate those things with them, what if this thing goes wrong or that thing? Then they'll begin to realize, okay, maybe my risk tolerance is lower than I thought it was. But if you just hand them the form and say pick between 1 and 10, you're not going to get the real answer.
Yeah. That's why, and also this is a good point. Coming back to even the plan itself, and when you use that kind of approach, is you can know what is the required rate of return, and then you can guide the clients better. Then okay, well that is the minimum rate of return you need to kind of get in order to achieve your goals. Then okay, are you in line with that? Is it aligned with your your risk tolerance based on your questionnaire and your risk capacity. But then if you do want to wish to take more risk, then you know why. And if you don't have that risk capacity or risk tolerance, then we need to adjust the goals and in order to, so that everything kind of is in line. But yeah, when you have that conversation, it's a lot easier than, like you just said, relying on kind of clients' answers, which sometimes can be a misrepresentation of their true score, which is your point. Okay, I want to move on to case number 2, which let's give the consideration. We've alluded to that already, but I want to touch on the second case in this episode about the private markets, which is a huge area of growth. So when we look at private markets, we're talking about private equity, private credit alternatives, which I'll define in a second. But you've had multiple cases. Sorry, there was multiple cases against private asset managers, and that you mentioned that were stopped through private arbitration. So before going to court, is that correct? Can you explain why? And then that was mostly in the US, right? Can you give a bit of a summary of like what's been happening in that market in the US?
So I think it's a very interesting area. It's a big interest of mine because I think so. I would say it seems pretty clear. A lot of people have observed that there's kind of a push for more private assets to be reaching retail investors or people further down the wealth hierarchy. And traditionally, these were sort of the purview of institutions or ultra high net worth individuals. So the incentives that people have to sue are quite different there, even if they suffer a loss. And the reason the US is interesting is because they're a leading indicator in litigation in a lot of ways. So you'll frequently see a lawsuit in the US and something will follow in Canada, Australia, wherever else, just because of the activity within their market and the size of their capital market, right? There's a much deeper pool of people involved in it. There's a lot more going on. And you don't really see much in terms of private assets. And that is because I think of arbitration clauses. So an arbitration clause is an agreement that you won't sue. You'll have this dealt with privately, usually on a confidential basis. We'll hire our own private judge, an arbitrator. All an arbitrator is a private judge. And we'll deal with it with our lawyers in private. Then normally the court process is public. People can show up, they can watch in the courtroom if something is happening, or a judge makes a decision that's public. Anybody can go and read it. They can look up the people involved. So understandably, people often don't want that, particularly for commercial disputes, and they'll agree to arbitrate instead because they still need a way to resolve the dispute. So that is something that you would see, and I expect there's probably a lot of in terms of institutional investors and private asset managers. And US courts are quite willing to enforce arbitration clauses even against closer to normal consumers or closer to the average person in a lot of circumstances. Canadian courts are less inclined. So I think that we'll actually see quite a bit of this in Canada, perhaps even before in the United States. But you have an asset manager, they might have an ongoing relationship with a pension fund that's purchasing their private assets. Those two entities don't want to sue each other in the normal course, probably. They have an ongoing business relationship. They're looking at beyond the single fund that's suffering a loss. They're probably looking at it from a portfolio perspective. Some people working at the pension fund might want to work at the private asset manager. They might be involved in the decision-making process. There's a whole bunch of reasons that neither of them will want to sue. You take a normal investor, an everyday person that until now was probably largely buying mutual funds, completely different calculus. They don't care at all about a continuing relationship with the fund manager. They probably want nothing to do with them ever again as a result of this anyway. So there's no incentive for them to want to kind of smooth this over amicably. There's every incentive for them to potentially explore court, whether that's for a class action, an individual lawsuit, or a group of people getting together and deciding they want to do that. And with this push towards greater retail participation in private markets, I think you're going to see a pretty big shift in terms of the number of people that are there that are going to have the incentives to actually do something about some of these losses compared to what we've seen in the past.
Yeah. Okay. Before I ask you more questions, I just want to set up the stage for the investors here. So, the listeners here about what I'm talking about. And then after that, I want to ask Matthew a few questions about, private markets in Canada and the protections there for investors. But I just want to define for the listeners, if you're not familiar with this. So, private markets, they're investments that are not traded on the public stock exchanges. So, there's no daily price, there's no ticker symbol, there's no easy exit. It's money typically locked for years. Historically, these private markets were reserved for institutions and ultra wealthy. I did work for a family office for a short period of time, so for a billionaire, and I was exposed to these, and they will lock up period for decades, right, and multi generations. But you think about pension funds, endowments, sovereign wealth funds, those were the players in that game. But now, like Matthew alluded, it's been sold aggressively to high net worth individuals. So people usually who tend to be closer to the 1 million investable assets and plus, their advisors will pitch them called the endowment model because it's so huge it's so leveraged by the pension funds and the likes and it's been popularized by the Yale endowment, the Yale endowment in the US. I'm not sure if you're familiar with that. And then after that, all the endowments were kind of replicating that. And then now the pensions have like adopted that model where a large portion of their assets is in private markets. And now the retail portfolio managers and advisors are now replicating, using that playbook and presenting that to the high network. So this is how it's been kind of trickling down to now retail investors. And everyone you look left and right is offering some sort of exposure to private markets. It's the hottest thing around. So what are the main categories? So private equity, you buying ownership stakes in private companies, private credit, private debt. So you're lending directly to companies outside banks or the bond market. Again, that can be very appealing if you're someone who needs income, right? That can be a solution there. Then you have real assets, infrastructure, farmland, timberland, real estate, venture capital. This is early stage investing. But the appeal, and then there's alternatives, which now you can look at hedge funds, commodities, and derivatives, and so on. But the appeal of this is a lower correlation to the public markets, right? Stocks, public stocks, and public fixed income, and higher potential return. Again, that's questionable. And then higher income in a low yield environment. So when yields were really low, those were really popular because, you can get much higher yield. You can get a whole lot from government bonds. And then, maybe highly graded bonds were not giving you much either. But the catch is complexity, opacity, and illiquidity. Now, the last point here is around gating and redemption. So how do you access your money? We just said it's going to be locked for years. But when you try to take your money out of a private fund, the manager can limit or deny your withdrawal. So most funds are cap redemptions at 5% of assets per quarter. If more investors want out than the cap allows, your request gets queued and sometimes for a year or more. And this is written in the fine print that many investors don't realize it until they try to leave. Now, how is this applicable to Canada, you might say? Well, this is from an article that was published by a real estate managing partner in Kelowna. But the situation playing out right now in Canada in the private real estate sector, about 30 billion, nearly 40% of all capital invested in Canadian private real estate funds is currently locked up as managers restrict redemptions, halt distributions, and put investors on waiting lists. The gating wave has touched some of the biggest names in the space: Rumspan, Nicola Welt, Hazelview, Tres Capital, Century Apartment REIT, and Kingset Capital's Real Estate Income Fund, among others. Then the latest one is Avenue Living Asset Management. This is a Calgary-based fund, which at our investing conference, they're pitching us every year, which is, so I know, I've met them and I know of them. We get pitched all the time, these solutions, but yeah, they are effective March 31st. Redemptions are frozen for up to 6 months. So this is an example of you try to get your money out, you can. My question to you, are investors adequately protected in private markets in Canada?
My view would be no. Like you said, there's a lot less protection available. One of the sort of fundamental principles of Canadian securities law generally is disclosure and equal access to information. And to access public markets, historically, you need to publish what was called a prospectus. That's a very detailed document about everything about your business or your fund. It typically has audited financials. It gets regulatory approval. The Securities Commission says whether or not they think it has adequate disclosure. And then as you continue to remain in the public markets, you have regular periodic reporting requirements as well. So there's a great amount of information available. And even if neither you nor I or the average person can read it, there's a very active body of people. There are analysts out there who follow specific sectors very closely and they digest the information that's available that way and they present it in more palatable ways. And all of this affects the price, like you're saying, is generally, if it's not a super thinly traded stock, it is a market price that's based on a good amount of activity. And like you said, you don't really have that information. You might have almost no information when you're investing in a private product, and you might not really have any way to validate any of the information either. So there's a lot of mismatches in terms of whether or not people are even able to tell if something is going right or wrong. You don't have this sophisticated body of information processors that you can turn to try and understand what's happening with your money. And beyond that, like you said, there's something almost of a structural mismatch in terms of timelines. If you have decades where your money is locked up, for something like a pension fund, that make perfect sense. You might have pensioners, and you might expect to be paying out pensioners for at least the next 80 years. So if you're financing some huge project like a big toll road somewhere, it doesn't matter to you if you're not going to see a penny for a long time. You're thinking about your need for cash flow for distributions decades from now. The average person, unless they're primarily motivated by estate planning, they probably need their money much sooner than that, and that can be a big problem for them. And the idea of being gated is something that can be a big problem for them as well. And whether or not adequate conversations are happening with people who are finding themselves in that situation, if they're actually understanding the liquidity risk, if they have enough recourse, I don't really think that we're at a place where that's probably happening most of the time when these products are being sold.
Yeah. Where's the legal exposure lying in terms of, I mean, the asset manager, they have a strategy that, like you mentioned, they explicitly detail in their prospectus, and then they run. And of course, there are some risk involved in the strategy. But then where's the legal exposure on, is it on the dealer? Is it on the advisor? Where do you think it lies in terms of, yeah, recommending those products when they don't perform as
So I'd say there's a couple different kinds of risks and they lay at different levels. So certainly the advisor and the dealer can have exposure if, let's say, somebody is too concentrated in a private market product or the client doesn't understand what it is or they're put in it, it performs poorly. So that fits into the same analysis that we were talking about before for the advisor. For the dealer, if there's like a compliance issue on top of that, if they didn't catch the concentration risk and they should have, or there's some other flag that was missed, the dealer has exposure as well, and the dealer can also be liable for the conduct of the advisor. So there's definitely exposure there in a similar way to other assets. So there's something of a debate, or there can be a debate about whether or not an advisor can really meet their KYP obligations with respect to private assets because of this very low amount of information that's out there. So that's something that we don't have a clear legal answer on as of right now. There's certainly arguments going both ways. At the fund level, a lot of funds will choose to make some disclosure for an offering memorandum, and the content of an offering memorandum is much more flexible than a prospectus. So there's exposure for the fund if they make misrepresentations in the offering memorandum, if they don't accurately present the information that's in there, if they leave out something important that makes something else in there misleading, they could have exposure if there are losses that result from that. There's something in the Securities Act that explicitly addresses that. If they also, let's say, create a conflict of interest that favored them over their LP unit holders, there could also be exposure there. And the simplest example for that would be valuation and return metrics. So the way that these products, their return is reported is actually quite different from an individual stock where people will see a straight line percent. I invested in mom and pop Inc. It gained 20%. I gained 20%. I cashed out. These usually have a stream of income and then some redemption at the end, so you can't perform the same analysis. So they'll usually report an internal rate of return. And that's not a one-to-one with the straight mom and pop Inc. percent return piece. So the way that people explain their returns, the way that they present their returns, that could be misleading. And the biggest conflict is probably valuing these. Valuing a publicly traded security is quite simple for the most part because you have a market for it. Here, there's usually a valuator and maybe an internal valuation process, which I think has the biggest conflict of interest because they're typically being paid a fee based on the valuations. So there's obviously an incentive if somebody were unscrupulous to value their assets at our official level. But the way that the valuation works, if it's not something that's done independently, then there's a lot of possibilities for conflict, or if somebody was artificially inflating their valuation or trying to smooth their valuation to create the appearance of more consistent performance than what was actually happening. Those are all instances where I could see the fund manager itself potentially being liable as well.
That's interesting that you touch on. Yeah, that's a big piece, which falls into the opacity component, is just the nature of their assets and again the reporting schedule. And this is the question: right? If you're in the forest and a tree falls, did you really? So you were not there. Did it really fall? Or like if no one is there to hear it. The analogy here is that because it's not marked to market every day, does it mean that it is the volatility is lower, or is the volatility actually smoothed or being underreported? Which maybe like now, if you were marking to market the assets, then maybe the volatility is a lot closer to maybe what we find in public assets, which is also one of the biggest, I would say, benefits or premise of these private assets as well, right? Lower volatility, higher return sounds amazing. It sounds like the holy grail. But then maybe as we continue to see more transparency in their requirements, then yeah, there might be a lot to uncover there. And to your point, there might be potentially legal exposure there as far as like maybe the practices that they've been implemented, right? Especially if there's conflict of interest of who's valuing those things and who's all those which is, yeah, it's just fascinating. Question for you is, can we just kind of hide in terms of around consent from the client? Like what I mean by this is, when you look at all these, I would say, more very complex investment strategies, when you look at the endowment models that is replicated by the vast majority of portfolio managers who are managing money for high net worth, like their clients don't understand nearly of what's going on under the hood by far. That's what I would presume. And I also have my own experience in meeting with these clients where I was explaining them, like, do you understand why you're holding this, right? And I've seen all sorts of portfolios from those high net worth individuals. But can an advisor, once you get consent from your client, is that sufficient enough to basically meet the requirement and like get you off the hook?
So consent will play a role in a legal analysis for sure, but consent isn't as much as a simple yes or no. For it to be meaningful, it's got to be informed consent. The person then needs to actually understand what they're consenting to. So the conversations surrounding that, the type of information that's given in that process, and the way that it's documented are going to be very significant determinants of whether or not the court is going to use that to find that the advisor fulfilled their obligations or not. So, unfortunately, the answer is it depends. There isn't an easy one, but just a purely formalistic somebody signing something that says that they consented, might not even know, or they just say yes to a particular trade. It's not meaningful if they don't actually understand what was happening, if they don't understand the risks, if they don't understand what it means for their overall financial position. And I think the area where that probably comes up the most is margin authorization, because people need to execute paperwork to access margin facilities at a dealer. Somebody will sign something as a result, but that doesn't mean that the conversation actually took place about what margin does to risk, or what a margin call could mean for their financial situation, or whether or not they might need to remortgage their house or liquidate assets at a bad price to actually meet that call, should that come to pass. So being very clear about all of that and having robust documentation is the best that somebody can do, and that will be very helpful should they find themselves in a legal dispute.
Yeah, that's a good point. It also, this is a kind of tangent on just the fact that today, like all my meetings are on Zoom, on virtual, and also with AI note takers and whatnot. And I feel very confident that there's no like he said, she said type of debate, because we can always go back. Let's say when it was an investment presentation, this is kind of how I've explained the strategy or how the client's money is invested, or given that everything is recorded, I feel a lot more safe and secure as an advisor. And also, let alone the fact that I can go back and analyze the conversations in order to be better at communicating with clients. But I feel this is also a huge part of what has been said, and like was it enough? So I would assume that maybe someone who's out there pitching all sorts of complex strategies, one reason is like you just mentioned, what was disclosed, how was it disclosed, and how was it explained. I would assume if they do have, yeah, the I guess the recording to back it up, that must like be supporting their case a lot more. Would that be accurate? Do you think that's a change in the industry, that maybe like you go back 20, 30 years, like you didn't really have that, like you just have the forms, but it's probably a lot harder to defend as far as like, oh yeah, I've explained everything in detail, but maybe some really important parts were were missed or glanced over?
Yeah, so I definitely think the body of evidence that's going to be coming up in these disputes is quite different. And generally speaking, in civil litigation, you need to disclose all your documents that are relevant to the dispute. And documents includes audio recordings, it would include those videos, transcriptions, whatever. So I think the side that has the better case probably stands to benefit from that kind of thing. But even before all the AI note taking, recording everything, I've cross examined somebody on a voice note that they sent before. Like I had them under oath and I was playing the voice note to them, asking them to confirm yes or no, you were describing this strategy as low risk. That's your voice. You said that. So if you're not doing your job, I imagine it's probably something that would be very uncomfortable for you. If you're confident in what you're doing, like you're saying, I think that will be helpful to you. But the rule generally in a lawsuit is that what one side has access to and they want to show the court, they need to give to the other side. So it'll cut both ways depending upon the specific facts.
Yeah, interesting. I know we're coming up almost the hour here. I want to ask you a question, very briefly on the fraud type of thing as well. But what's the most common mistake everyday investor make that makes them vulnerable to fraud or negligence? Something that feels normal but is actually a warning sign.
I think one of the biggest things that I get contacted about, and unfortunately it's something that generally we can't help with, is really just people sending money to folks that they met over the internet or they interacted with over the internet. There's an enormous amount of AI enabled fraud that happens through social media now. And I've been quite surprised by the extent to which people are willing to spend 5, 6 figures worth of money to people that they never met. And unfortunately, unlike an advisor that's registered with a provincial regulator, they're attached to a business that you've heard of. There's a street address where you can actually track them down. There's a way to get that money back if something goes wrong. If it's you find yourself in an Instagram group or you're listening to somebody on TikTok that's telling you to follow some links and that they're going to give you an 80% return, and frequently you're dealing with somebody that's got nothing to do with Canada. The second you send your money, it's going to filter through 4 or 5 different bank accounts, and it's going to end up in a completely different country where it's going to be very difficult and expensive to track it down. So I think just doing a very basic level of diligence on the people that you're dealing with. And the Canadian Anti-Fraud Centre and the provincial securities commissions, they have pretty good educational resources on this, on how to identify investment fraud, red flags. I would suggest everybody, if they're considering sending money to somebody, take a look at that. They don't do enough to get that information out there, but if you actually go to their webpage and take the time to read it, it's pretty high quality stuff. And if we covered even that degree of information in the education system in some way, I think that would go a very long way to combating a lot of the investment fraud that we're seeing.
Yeah. It all comes back down to knowledge and education, and it can go such a long way, let alone helping people build more wealth, but make better financial decisions for themselves, but also avoid like very, very costly mistakes and potentially pitfalls, like dealing with someone who might be negligent or where they might get scammed in your example, right? Like, yeah, sending large sums of money to just out there, that's scary. It's very, but it happens. I guess I'm assuming it's all on the premise of huge returns and huge potential wealth, and I guess that can sounds very appealing for a lot of people, right? I mean,
And yeah,
people buy
a lot
lottery
of people
tickets all the
don't
time.
know. They
Yeah,
don't know a lot of the time either what is realistic, right? Like if
yeah,
somebody
exactly.
doesn't
Yeah,
disclose your education, 80% might not sound insane to them. But
yeah.
I think anybody who's got a bit of education is going to know this is either a ripoff or there's an enormous amount of risk that's baked into this.
Yeah. Yeah, they can't discern exactly the validity of the claim being made. Yeah, that's a good point. One last question here. If you could change one thing about how securities regulation or investor protection works in Canada, what would it be?
I think the complaint handling process is a pretty major issue. And the way that it works right now is there's the Ombudsman for Banking Services, OBSI, and they can make a recommendation if people complain, and the company can accept that or they can disregard it. It's not actually an enforceable thing. But to even access the OBSI complaint process, you need to go through the firm complaint process first. And different firms approach it differently. They will frequently bounce people between different departments. They might get them to sign things that may give up some of their rights. They may think that they're dealing with somebody that's independent that's not. And I think that there's a lot of people who can't afford a lawyer who find themselves with a claim, and their first stop is the OBSI process. But even for people who can afford a lawyer who go through that, time is ticking the whole time and it doesn't toll the limitation period. You have a certain amount of time that you need to sue within. It's usually within 2 years of when you experience your loss, but that can change in specific fact situations. So if people take a while to realize it, they need to go through the complaint process. And then the OBSI complaint process itself, I think, has a 90-day response time. All of this can really add up, and people's rights might actually lapse on them without even realizing that. So I think that fixing the complaint process in terms of how dealers need to deal with it, in terms of what OBSI can or can't do, would go a long way to protecting people's rights without needing to incur a huge cost or needing to go to a lawyer first, because that is probably the primary portal of access for most people who can't afford to seek outside representation.
Well, thank you, Matthew, for coming on the podcast and sharing your insights and educating us on the intersection of investment and law. That was really insightful even for myself, and I hope it was really useful for people listening to this, and hopefully it can help them avoid some costly mistakes that they might pursuing a certain strategy that might not be in their best interest.
I hope that's right, or at least identifying for people that they might want a second opinion. I think that'd be one of the biggest takeaways, because even if everything is going right, there might be value to that. But if there's not, hopefully that catches of things before they go too wrong. Thank you again for having me. It was a pleasure. I enjoyed this a lot, and I hope that your listeners find value in it.
Yeah. What's the best way to? I'll put the link in the show notes in terms of your website, your LinkedIn, if people want to connect with you, and your email as well. Any other places where whoever is listening to this conversation and would like to reach out to you, any other places that would be best to direct them to?
No, I welcome people to reach me on LinkedIn for whatever reason, or if they feel that they want a consultation or it's something more formal, I'd suggest my office email or phone number. You can reach me at either of those. That's the best way.
Awesome. Well, Matthew, have a good rest of your day. And for the listeners, thank you for listening, and we'll see you in the next episode.
Thank you again. Take care.
Thanks, Matthew.